So I just wanted to welcome everybody to our third keynote of the day. We are very lucky to have Pierce Hahn join us today to present on corporate formation and structure. Pierce is a senior associate at Nixon Peabody in the M&A corporate transactions group. He's got a lot of experience doing a lot of big M&A deals. So we're really excited to have him here today.
I'm just going to get started with the what. Every new small business has to figure out, obviously you need to start your business, but once you have that all down, you have to figure out what kind of business structure you want for your new business. And, here are some of the most common business structures. It's not all, but I'm sure most, if not all of you already have heard about these before, but it's typically you're either a sole proprietorship, a partnership, which can be in the form of an LP, a limited partnership, or an LLP, a limited liability partnership. There's a limited liability company, LLCs, or you're a corporation, which you can be a C Corp or you could be an S Corp. Again, this is not an exhaustive list. There's, of course, nonprofits, B corporations, and closed corporations, but I'm going to focus on these most common business structures. Your business structure is obviously very important, and it's one of the things that clients always come and ask, what's the best entity type? Unfortunately, there isn't really a great answer for that. It's a typical lawyerly non-answer, which it really all depends. It depends on you, it depends on your business, it depends on your partners, depends on where you're located. There's a whole myriad of factors that you have to consider when choosing your business structure. So it is a very important decision to make, and it's not one to be made lightly, which is why you should seek counsel before making that decision. But let's just say you went down one path, you're not stuck forever. You can always convert or change your business structure, but it may take time and effort and additional fees for converting. So it's just something to think about. The business structure you choose will influence everything from your day-to-day operations to how you're taxed, your ability to raise money in the future, the paperwork you need to file on an ongoing basis, and the big ticket item is your personal liability. So again, you should choose a business structure that gives you kind of the right balance of legal protections and benefits. So the first most common is a sole proprietorship. You're technically automatically considered to be a sole proprietor if you are involved in business activities and you don't or haven't already registered as another kind of business type. So an example of this would be someone who is self-employed, a freelance artist, or someone who is an independent contractor, someone you work for yourself. It can also be someone who's selling art or widgets on Etsy or eBay. Those are your sole proprietors. There's some advantages to being a sole proprietor. It's very easy. It's inexpensive to form. You really, again, don't have to do anything because you probably already are one if you're doing business activities. It's the simplest and least expensive. Another advantage is you have complete control over your business. Because you are the sole owner of the business, you control the business and all the decisions about it. Another benefit is simplified taxes, in the sense that the business yourself is not taxed separately. So it's easy to fulfill the business's tax reporting requirements. It may complicate your own personal taxes, but on the business side, it's a simple process because your taxes are one and the same with your business. So again, because there's no separate business entity from yourself, there are some disadvantages to being a sole proprietorship. The big one is you have unlimited personal liability. You can and will be held personally liable for the debts and obligations of the business. It's the simplest way to think of it is you alone are responsible for the success and failure of your business. So it cuts both ways. Another thing to consider about sole proprietorships is it's hard or near impossible to raise money. You can't sell stock in the business. You can't sell stock for yourself, and because of that, investors won't want to invest in the business because they'd essentially be just giving you free money or a loan. They won't own any equity in you yourself. So it's hard to raise money that way. It's hard to raise money with banks the typical way because banks are always willing to give you a personal loan, but it's hard for banks to lend a significant amount of money to a business because there's a perceived lack of credibility when it comes to repaying if your business fails. So who is this good for? It's sole proprietors are great for low risk businesses. If you have a lemonade stand, or you're just doing something small on the side, or you're selling something you're making at home and you're just selling it through eBay or Etsy. But or if you're just starting out, it's a great option. If you're just starting out, you're not really sure if your business, if you have a business, if it's just kind of like a product and you don't want to waste time, money, and energy investing in a more formal business type structure. So the next common entity type are partnerships. Partnerships are the simplest structure for two or more people to own a business together. Partners agree to share in the profits or losses of the business, which is typically documented in a partnership agreement, but you don't always have to have a written agreement. As a lawyer, I would highly advise putting everything in writing to avoid disputes in the future between your partners and the other owners. But it's not, depending on the state where you form your partnership, it's not required to have a written agreement. So you could have an oral handshake deal between you and your partner. There are two main types of partnerships. There are limited partnerships, LPs, and LLPs, which are limited liability partnerships. LPs have at least one general partner, and that general partner will have unlimited liability. All the other partners will be limited partners, and they will have limited liability. The flip side to being a limited partner is it's great. You'll have limited liability, but you'll also have limited control, and typically that means you'll also be limited on the profits and losses of that entity. So the next type is again, limited liability partnerships. Those are typically for professional professions, like professional groups, like attorneys, like my firm, Nixon Peabody, is an LLP, or accounting firms. An LLP protects, it gives limited liability to every owner, and it protects each partner from the debts against the partnership, so they won't be responsible for actions of other partners. They won't be personally responsible for actions of the other partners. A primary advantage for being a partnership is that the partnership itself does not bear tax burdens. The profits or losses will pass through to the partners, and the partners themselves will report on their individual tax returns. The disadvantage to having a partnership is, at least for the GP, the general partner will be personally liable for the financial obligations of the business. Again, kind of like the sole proprietor. Whoever is the general partner, you know, will have unlimited liability, but they'll also, if the partnership is doing great, he'll also get the upside and have all the profits. Whereas the limited partners will have less liability, but won't get the benefits of those profits. So it's a give and take. So who is this entity type for? It's for again, those that are starting out, and if you have you know, more than two people who are trying to start a business together. So it's for multiple owners and groups who want to again, test the waters. You have an idea, you have a product, and you don't want to invest too heavily just now until you see if your business will actually take off and it's worth investing more in. The next one is a limited liability company. This is kind of a hybrid form of partnership and corporation. It allows owners to take advantage of the benefits of both forms of business. So the profits and losses can be passed through to owners without taxation of the business itself. And the owners are shielded from personal liability. You know, the profits and losses will be passed through to your personal income without the corporate taxes, but because the owners or members of an LLC are considered self-employed, they are still subject to self-employment tax contributions, such as Medicare and Social Security, if you're a U.S. resident. So it doesn't totally avoid all forms of taxes. It's just a different manner in which you get taxed. But the advantage for LLCs is liability in most cases. Your personal assets, like if you have a vehicle, your house, your savings accounts, those won't be at risk if your LLC faces bankruptcy or a lawsuit. One thing to keep in mind with an LLC is that in the United States, every state has their own statutory regime, and so in many states, if a member or owner joins or leaves the LLC, some states may require the LLC to be dissolved and reformed with the new membership, unless you already have in place a written agreement, also known as an LLC agreement or an operating agreement, that specifically lays out what happens when a new member comes in, and specifically deals with what happens when an owner or a member is buying, selling, or transferring their ownership. So another reason why everyone should want to have everything written down on paper and all of the owners, members agreeing by signing the agreement, this is what happens. And then you can avoid having your LLC be dissolved by having a new member be added. So who is an LLC good for? It's really for owners who have significant personal assets that they want to be protected. Really, it should be for any owner who has assets that they want to be protected. And, you know, you presumably want your assets not to be subject to bankruptcy or a lawsuit. And for owners who want to pay a lower tax rate than they would with a corporation. So a corporation is sometimes also known as a C Corp, is a distinct legal entity that is created to conduct a business. The corporation itself is a separate legal entity from those who created and founded and who handle the responsibilities of the organization. So just like a person, an individual, the corporation itself can be taxed and can be held legally liable for its actions. The corporation itself can also make a profit, and and so, again, the key advantage for having corporate status is the avoidance of personal liability. It's actually the strongest entity type to protect yourself from personal liability. Because again, you have a specific distinct entity from yourself. If your business as a corporation were to get sued, only in very rare circumstances like fraud, can a court go after the owners for liabilities of the corporation. The downsides for a C corp is there's a higher upfront cost in forming the entity, and there's a lot of ongoing costs, and it requires a lot of record keeping and operational processes and periodic reports. So there's just to throw out in Delaware, there's ongoing annual filings that are required for corporations, and if you forget or miss your filing deadline, there's a penalty and a fee. And of course, every time you file that annual filing, you have to pay your annual franchise tax, which I'll get into later. So it's not a one-time filing with your state where you form. It's an ongoing thing, and you have to continually update with your state where you form your corporation. So it can get very expensive, especially if you're really small. You're running the business by yourself and you're growing. It may not be worth forming a corporation until you're bigger, or until you're going to scale and have that have the finances to where it makes sense to form a corporation. Another problem or disadvantage with a C corp is, unlike a sole proprietor, partnership, and LLC, corporations have to pay income tax on the profits that the corporation itself makes, and so the corporate entity itself will be taxed if it makes a profit, and then if the company makes a distribution or dividends that are paid to the shareholders of the company, then those shareholders will also pay a tax on their personal tax returns. So it's known as a double taxation. So you get the benefit of having a complete distinct entity, a completely independent life separate from yourself by having a corporation, but you may and will likely pay higher taxes. The difference with the LLC is kind of like what I mentioned earlier, is if a new member is added or leaves, you don't have any risk of your corporation being dissolved. Corporations have perpetual existence. So until a corporation is completely liquidated and dissolved, having a shareholder leave the company or sell his or her shares doesn't cause the C corp to be dissolved or to extinguish its existence. So it can live forever. The other benefit for having a corporation is, if in the future you're thinking of raising capital, raising funds through the sale of stock of the company, that's a huge upside for investors, or if you want to go public one day and be listed on a stock exchange. That's those are all corporations that are listed for most corporations. Those are the ones that are listed. I mean, there are examples of companies that are not corporations that are listed, but they're very rare, and they're for very distinct purposes. And another thing that is a benefit is, if you do have stock, you're a corporation, it's a way to incentivize and attract employees, because you can give stock or equity in your company. If you're trying to attract a new executive, for example, you can give stock options. So that's much harder to do in another entity type. So again, who is this for? It's for businesses that want to raise money or plan to go public or be sold in the future. The other main type of corporation is a S Corp or a subchapter corporation. They're very similar to a C Corp, but it's a special type of corporation that's designed to avoid the double taxation issue of C Corps. But S Corps, in order to create an S Corp, you have to follow very strict rules, and the main ones are that you can't have more than 100 shareholders, and all the shareholders have to be U.S. citizens or residents in certain instances. So if you have a foreign shareholder or you want to bring in a foreign shareholder and you're already an S Corp, you will have to convert to a C Corp in most cases. So it can because of these rules, you may be barred from creating an S Corp from the very beginning. So that's why not everyone just automatically creates an S Corp. But if you are able to create an S Corp, there are some big benefits because it gets rid of that double taxation that I discussed earlier about C Corps. S Corps will allow the profits and some losses to be passed through directly to the owner's personal income without ever having to deal with corporate tax rates. One thing to note, though, is that not all states in the U.S. recognize or tax S Corps equally. Some states will tax S Corps on profits above a specified limit. And again, some states don't even recognize the entity type of an S Corp, even though the federal government does. And it'll simply treat and tax the business as a C Corp. So you would need to get specific tax advice and discuss with your tax counsel whether your entity qualifies to be an S Corp and whether you're in a jurisdiction where that election wouldn't even help you because you'd be taxed anyway as a C Corp. In order to create a S Corp, you have to file with the IRS, you have to get approved, and you have to get S Corp status, which is a different and distinct process from registering with your state, which I'll get into shortly. So who is this for? It's for any business that would otherwise be a C Corp, but can meet the criteria to file as an S Corp. So now that I've gone through all those different types of entities, your next consideration is where do I form? And again, the answer is it really all depends. Your business location determines a lot of things like the taxes, zoning laws, and regulations that your business will have to adhere to. So you'll want to make a strategic decision about where you start your business in. If you haven't already started your business and you're able to move or choose, you'll need to register the business and pay taxes in that state and jurisdiction. And you may have to get specific licenses and permits from local governments in order to run your business out of that location. So you have to think about your target market, your business partners, your personal preferences, what you may be thinking in the future. Those are all things you should think about. But in general, it's really the costs, the benefits, and sometimes there are restrictions like government agencies that will dictate where you should form your entity. If you already are running your business and you're already transacting business in your home state, it may make sense to just go ahead and form your corporation or LLC in the state that you reside, if you reside in the U.S. And the issue is that every state defines what conducting business is differently. Most are the same or similar, substantially similar, but every state may have a different nuance, again, which is why you should reach out to counsel. But most states will require you to either register in that state if you have a physical presence, like you're renting or leasing or owning a physical storefront or real property, or if you have employees working out of that state. So again, if you conduct all of your business in your home state, then you would only need to meet the statutory requirements for that state. But if your business operates in more than one state and crosses state lines, or if you grow and you expand, you may then have to file in that additional state, which comes along with additional fees, periodic reports, and administrative burden. So as you get bigger, there's just more chances that another state will try to get another bite at the big apple of getting more tax income from you. So another thing to consider is your state taxes. There are specific states in the U.S. that are known to charge no corporate tax at all, which is a big incentive for those who are thinking of starting a new business. Nevada, South Dakota, Washington, and Wyoming do not charge any corporate income tax. And also Alaska, Florida, and Texas don't charge any personal income tax, along with Nevada, South Dakota, Washington, and Wyoming. So those are states that could become attractive to you depending on your circumstances. But again, you should consult tax counsel, because even though they may not charge corporate tax or personal income tax, they may charge some other type of tax. Like in Nevada, they don't charge it. Some people consider it a tax oasis, but if you have employees in Nevada, you have to pay a payroll tax. So it's kind of it can be very convoluted. Taxes are always very complicated. So you should always get tax advice, but even if you may not have the main big scary corporate tax, there may be another avenue that state is trying to get money from you. Another thing to consider is public information and online filings. That can be considered an advantage or a drawback, depending on your business and your concerns. Florida is one example where it provides very user-friendly online filing services. So it can save you time and money. You can really search any company that's been created in Florida. You can look at their articles of incorporation, the other relevant documents that are publicly available. That includes their annual reports that they file every year. You can see the names of the officers, directors, some of their addresses. So that could be a benefit if you're really unorganized and you just want to quickly search and find all the background corporate documents that you haven't looked at in years, or if you're trying to show a potential investor the background information. Anyone can just quickly go and get it, and most of it is free of charge. But on the flip side, if you're trying to conceal assets or avoid lawsuits, and you don't want all of that to be public, there are other jurisdictions that are better for maintaining anonymity and not being so public. So it really just, again, depends on your circumstances. Delaware is everyone always asks about Delaware. It's the most famous in the U.S. for corporations. It has a very uniquely pro-business reputation. It's where most, I think it's like 50% of all U.S. publicly traded companies, and like 60% of all Fortune 500 companies are incorporated and are headquartered in Delaware. So there's a reason why. And the Delaware courts have really a long, 100, 150 years of experience of handling disputes and interpreting business laws. So you really know, you can go in with eyes wide open and know and anticipate how a court in Delaware would deal with something that got litigated in that state. So you kind of know going in that if something were to happen with your company, the likelihood of it being read or decided in a certain way, you have that benefit in Delaware because it's been around forever. So many companies have been incorporated and formed there. The likelihood of a problem that you're going to have to deal with has already been litigated in Delaware. And so you can see it really helps your legal counsel for sure on what is permissible and what's not. So you kind of know you're at the four corners of the law in the state of Delaware. But not everyone forms in Delaware, and you can form anywhere else. And most other states tend to look and follow Delaware corporate law, but not all the time. There are, California is another big state where a lot of companies form, and they follow Delaware, but they're not beholden to it. And so there are some instances where the courts diverge. So just something to consider. Another thing, is that although it has a very pro-business, it's known to be very pro-business in Delaware, it may not be worth forming in Delaware if you have no ties to Delaware whatsoever. If you're in Washington State, in Seattle, and you're a small business and you don't ever plan on going public, and obviously no one wants to be sued, so it may not be worth the additional expense of forming in Delaware when all of your business, all of your investors, all of your target audience is local in the state of Washington. You would just be paying extra $200 fees and additional filing fees every year to be quote unquote a Delaware company. It may not be worth it, depending on how big you are. But if you do plan to grow and you want to seek investors, a lot of investors expect or want to see a Delaware company, especially if you go public one day. Again, just you should look into the state requirements. Every state can be a little different, and some states have more favorable laws. Nevada, like I mentioned earlier, is seen as a tax oasis and also seen as very pro-business. There's no corporate income tax, personal income tax, or franchise taxes. And the state, like I said earlier about the public information, the state offers confidentiality to LLC owners so that you don't have to put your name. So you personally won't be tied to your LLC. So again, if for whatever reason you wanted to be anonymous or unaffiliated with your LLC, you could do that in Nevada. Wyoming is another state that's considered very business friendly. The reporting obligations are very minimal in Wyoming, and some states require you to have annual meetings in that state, but Wyoming doesn't care where you have you can have it virtually, you can have it outside of Wyoming, you could have it in China if you wanted to, but so every single state has their own statutes that you have to review, and just make sure that you're following the letter of the law in that state wherever you end up forming. Other things to consider are region-specific business expenses. So when you calculate your startup costs, you should take into account different expenses that might cost more or less depending on where you are. If you're, again, in Washington State, and you're making widgets and you have a component that is only made in New York, maybe it makes sense to actually incorporate in New York. If you're going to have to incorporate there anyway because you have, or if you're going to have to qualify as a foreign business anyway in New York because you have employees there who are making that specific component, it may make sense to just house everything in New York. So again, it all just depends on your specific business. The costs will vary significantly by location. And obviously there's living expenses, standard salaries, minimum wage laws, property values, rental rates, insurance rates. There's a whole gamut of costs that can come into play. So you should take those into account when you're thinking of your startup costs and where you decide to form. There's also local zoning ordinances. For example, if you're working out of your home, some neighborhoods are specifically zoned for either commercial or residential. So if you have a small business and you're running out of your house, and if you get caught or you're doing something that goes afoul of those zoning ordinances, you could be banned from running that business from that area, and you may have to pay a penalty and a fee, which could be high. So you should look into your local zoning ordinances. Again, state and local taxes, make sure you're taking into account the different types of taxes. I only really touched on corporate and personal income tax, but there are a lot of different taxes: sales tax, property tax. All of those things will vary from place to place. Again, some states are well known for creating tax environments that are friendly, so you should look into that. There's a reason why tech startups, financial institutions, and manufacturing plants are concentrated in specific areas around the United States, and it's not all the same. So there's a reason why. It's because companies are taking advantage of incentives and really friendly taxes. So state and local government incentives, you should look into. Every state wants to incentivize new companies to come to their state, to form in that state, because they want you to create jobs. And so a lot of them will give you a tax break for X number of years. They may pay for some of your startup costs in terms of your store or your building. They may invest in the building that you open your shop in. So there are a lot of different incentive programs out there that are designed to help with job creation, energy efficiency, urban redevelopment, and to incentivize technology. So you should look into those incentives, because that may also help you decide where to form your entity and start your business. And then the last thing is for the federal government. The U.S. has offers certain benefits to small businesses that work with the government and have contracts with the government, or are utilized or are based in underutilized areas, again, because they want to incentivize growth. And then there's also programs for veteran-owned businesses and minority-owned businesses. So those are, if you qualify for those are things that you should also look into, as that may help you decide where to form. So now that you've figured out your type of entity and where you want to form, you have to actually do the paperwork and pay the fees and register your business. So there are things to consider for federal agencies. Most businesses, unless you're in a really highly regulated industry like banking, for example, or like oil and gas, most businesses don't need to register with the United States, with the federal government. You would only need to do it locally. But the one thing that all businesses will have to do is get a federal tax ID, also known as a EIN, or employer identification number. That's a way the federal government is tracking your business, and for the IRS to come after you for taxes if you are making a profit and not paying your taxes. But small businesses should always think about other things that they may need to register with the federal government, such as trademark protection. Or if you're going to become a nonprofit, you would need to file with the IRS for tax exempt status. Your trademark or any IP, you would have to file with the Patent and Trademark Office. And again, for the tax exempt or for S Corp status, you would need to file with the IRS. For state agencies, you typically, depending if you're going to form as an LLC, a corporation, or partnership, you would need to register with the state where you are conducting your business activities. And typically it's a 3 to 5 page form. You're basically filling out the material information about your business, such as your name, the address, the owners of the business, what your business purpose is in that state. You fill that paperwork out, you file it online, and you pay a nominal fee. It can range anywhere from $100 to $300, again, depending on the state. And so kind of what I mentioned earlier with the foreign qualification is that, just because you form your entity in Washington doesn't mean that you may not also have to register in California if you have an employee in California or a storefront in California or in Washington, D.C. as well. So as you grow and as your footprint grows and you have employees and storefronts and real property in other states, you're going to have to, again, register in those additional states. And so it really, most states will tie that to a physical presence in the state. If you have in-person meetings with clients in that state, if you're getting a significant portion of your revenue from that other state, or if you have employees working in that state. But if you have a one-off meeting in Arizona, that doesn't necessarily mean that you need to file in Arizona. So you really need to work with your counsel and look at what business activities you are conducting to determine if you need to register in another state. The registered agent is basically it's a registered agent in that state that is able to receive official papers and legal documents on behalf of your company, and that registered agent must be located in the state where you register. So again, if you're in Washington State but you choose to form your entity in New York, you will need to have someone in New York, a quote unquote registered agent that has an address in New York that is able to receive legal service of process from courts in that state. Even you can't just hide in Washington and act like you never received it. So every state will require you to have a registered agent in the state that you form. It doesn't necessarily, you don't have to technically hire someone. It could be your own address. If you have an address in New York, you can have it come to that address, but you just need to put the address and who is your registered agent in that state. And of course, a registered agent is another nominal fee that you'll be paying some third-party service vendor to be your registered agent in that state. I went through the foreign qualifications already, and then the state documents that you file. In most cases, the cost will be around $300 or less, and you need to provide the business name, the business location, the ownership, management structure, and names of the directors sometimes, depending on the state, your registered agent information that I talked about earlier. And if you're a corporation, you need to provide information about the number and value of your shares if you're a corporation. So, and some states will require you to register a DBA, which is a doing business as name, which is also known as a trade name. So if your name if your business name is something different than the entity that you formed, you would need to file a DBA, which is another fee for the state. Another thing to think about when you're registering your business is in addition to the federal and state agencies, sometimes you have to register with your local county or city government. It's not typical, but sometimes you do. So you may need to get a business license from, so for example, if you work in New York City, you would have to register with New York State, but you will probably also have to get a license and permit from New York City. So it all depends on the location where you form, but you should look into those rules and get counsel to help you with that. And the last thing to worry about is wherever you register, and if you are in more than one state, you may have to provide periodic reports after registering. So in Delaware, there's a requirement for annual filings. So and if you miss it, there's a fee, a penalty, but it's different in every state. In Washington, D.C., your filing is only required every 2 years. So again, it's just something to remember, add it to your calendar, and just make sure you don't miss it because you don't want to pay your state another fee. So just to summarize, I know I've been running long. Just the things to think about when you're forming your entity is the legal liability. What extent do you want to be insulated from legal liability? Number 2 are your tax implications, based on your individual goals and the business owner. Where do you want that tax liability to lie? 3 is the cost of your forming your entity and the ongoing administrative burden for that entity. 4 is really flexibility. If you want to maximize flexibility of the ownership structure, you need to look into your own personal needs as the owner, but as you grow and have additional owners coming in, that may dictate the type of entity that you form. And then the last but not least is your future needs. Again, if you are just now a small business, and maybe being a sole proprietor is fine, but as you grow, you may need to convert if you want to raise capital, for example. But so, thank you for your time, and I know that was a lot of information. So please feel free to reach out or join my clinic if you have specific questions. Thanks.